So how can you leverage the 1031 exchange to avoid paying capital gains taxes on your rental properties? I'm going to break down this strategy for you right here, right now.
Sometimes in winter, I gaze into the streets and walk through snow and city sleep behind you. Sometimes in winter.
So when it comes to the 1031 exchange, what we're typically trying to do is transfer a rental property's value, sell that rental property, maybe that we purchased for 50,000 and it appreciated to 100K, sell that and buy a property within a certain time period that is of greater or equal value. So I'm going to sell that maybe single family rental property, go out and buy a multifamily, triplex, quadplex with the proceeds that I gained from that sale. And our overall goal is we want to try to avoid capital gains tax. You typically want to factor in about a 20% line item for capital gains. So it's about 20% of the profit from the sale. So if you sold this property and you made $50,000 in profit, the capital gain on average would be about $10,000 of that. So we want to keep that $10,000 and roll it into the next deal, thereby avoiding the capital gains tax.
Really fast, if you're enjoying the content, make sure you like and subscribe to this channel and click the link in the description to tap into my free real estate training that'll show you how to acquire properties for pennies on the dollar all across the country. You don't want to miss out on this free offer.
And the ultimate way to hack this system is to keep these properties, keep doing these 1031 exchanges into more properties, greater of equal value, better properties, more cash flow. And then ultimately hold this asset until you die. Because when you die, you get what's called a step up in basis upon death. So all of that taxable gain that is now hidden within these properties and has been rolled over and transferred over the course of the time, it all goes away. It gets wiped out at death. And the basis gets stepped back up so that your beneficiaries can inherit this property without any taxable gain. But that's just the overall strategy. Let's get into some of the line items here, the like-kind exchange. And what that means is you need to be dealing with real estate or business real estate. So you can sell a single family property and buy land with that. Those proceeds, or you can sell a single family and buy a multifamily property, or you could sell land and buy an apartment complex, or you could sell an apartment complex and buy a strip mall, right? You can go into commercial real estate. As long as you're in the real estate space, it is considered like-kind exchange. So you just want to stick with real estate. As we're looking at the title, when we do this 1031 exchange, the owner has to remain the same. So we can't own the property in our personal name and then transfer and buy a property in the name of the LLC, because that would not be a true like-kind transfer from an ownership perspective. So we would either have to transfer this property out of our personal name into an LLC and then do the transfer, or buy this property also in our personal name. There are some things you need to think about with title. I won't go a mile deep into that because I want to keep this video concise and compact. But just know that if you own this property in an LLC and you transfer it to another property that is an LLC or owned by the LLC, you're going to be fine. If you own this in your personal name and you're trying to do a 1031 exchange into a property that's held by an LLC, you may run into some issues there. You're going to have to do additional planning. Number 2 in the process is you need a qualified intermediary. This is basically a person that will handle the transaction. They're a third party. They're qualified. There are companies that do this type of work, and they do it for about $1,000 fee. So if you're out there looking for a qualified intermediary and you don't know what's a reasonable price, $1,000 appears to be around the ballpark of a reasonable price. But this is not someone you want to necessarily price shop. You're looking for somebody who's reputable. Why? Because there are court cases where somebody's gotten someone who's cheap and not reputable. And if that person who's the qualified intermediary has like creditors coming after them, or they get into financial trouble and they dip into the money that they're holding for you, and we'll talk about the escrow, if they dip into that money, there are lawsuits out there with that happening, that exact scenario. So when there are lawsuits and rulings on that, that means it could happen to you. Having this person be reputable is a very crucial part of it. So you don't want to price shop and get somebody who's cheap but has like no care about their reputation and will burn you. The qualified intermediary's job overall is to handle the transaction. They're going to fill out the proper forms that are necessary to be sent to the IRS to qualify this transaction as a 1031 exchange. And that form that they're filling out, the main one, is form 8824. This is what they have to fill out. It has to be filled out correctly. If you make any mistakes, you could bump up against some of these timelines, which we're going to talk about next, and that could really jam you up. But what they're ultimately doing is they're taking the money, the proceeds from the sale of your initial property, and they're holding that money in escrow. That money has to sit in escrow. If that money gets direct deposited into your account, wired to your account personally, it's not going to qualify as a 1031 exchange. So you need this person to hold this money in escrow, fill out these forms. You're going to pay them a fee for it, but this is what's going to help you to have that technical qualification as a 1031 exchange. So in the event of an audit, you can always go back and say, no, we did everything by the book. I paid my fees. Talk to the qualified intermediary. They did everything right. We're good to go. Step 3 is the time periods of the transaction. We have 45 days from the date of sale. So from the date of the sale of the initial property, I have 45 days to identify the properties or property that I'm going to be doing the 1031 exchange into. We're going to talk about those properties or the property and what the characteristics of that are. But just know that you have 45 days to officially identify these are the properties, or this is the property that I'm going to do the 1031 exchange into. And then you have 180 days from the date of the initial sale. So this is concurrent, right? You're not getting another 180 days from day 45. You're getting 180 days total. Within the first 45 days of that, you need to identify the property, and then you need to close on that transaction within the 180-day period. This is not 6 months. This is not 180 business days. It's 180 days. So if you hit day 180 and 1 hour, you go 1 hour over that, it's 1 a.m., it will not qualify as a 1031 exchange. You can run into some issues. Number 4, we have a holding period. You need to hold your properties for at least 1 year and 1 day. Purpose of this for the IRS is you have to be like a rental property, a landlord, a buy-in holder. This is not for buy-in flippers. This is not that strategy where you're gonna buy a property, sell it in 3 months, do a 1031 exchange, and just run up your gains and keep passing through. This is for buy-in holders, for owners of rental properties who at least intended when they purchased that property to have it as a rental. And part of that qualification for this 1031 exchange is this initial property has to have been held for at least 1 year, 1 day. So keep that in mind. This is a long-term buy and hold investment strategy tax loophole that we're going to master. Number 5, there are different value tests that we need to qualify for. There's the 3-to-1, the 200%, and the 95%. I'm going to try to break this down in a way that we can all wrap our minds around it. First off, we have the 3-to-1 value qualification. And what that means is in this 45-day period, we can choose this option, which is the 3-to-1 allows us to take this one property and say, I'm going to do a like-kind exchange into one of these 3 properties. So you would identify within that 45 days 3 properties that you intend to do a 1031 exchange into. I'm going to choose one of these 3. And as long as you close on one of those 3 within that 180 days, you're good. It's a 1031 exchange as long as it meets the other qualifications. But in terms of time period and selection strategy, you've committed to that 3-to-1. You selected and closed on one of those 3 that you've identified. This is a good transaction. Next, we have the 200% rule. And this allows you to take a property that's like $1 million property or a $2 million property that has $1 million gain. And you can sell that property and do a 1031 exchange into multiple properties. So this could be 5 properties. It could be 10 properties. If you sold a house in New York for $5 million and you wanted to dump that money into as many properties as you could in Baltimore, in Detroit, in Cleveland, you could identify as many properties as you want as long as the total value of those properties does not exceed 200% of the sales price of your original property. So if you sold this one for $2 million, you can't 1031 into multiple properties that exceed the value of $4 million, right? So that's the 200% rule. Just keep that in mind. That's a nice strategy if you have one big property and you want to 1031 exchange it into multiple properties that would have a higher cash flow. And then we have the 95% rule. And this says we can do a 1031 exchange from this property into infinite properties. We can lay out like 100 properties, right? As long as we close on a value that is within 95% of the total value of that pool of properties. It's a little bit more complex. This is more of a strategy for highly sophisticated investors who deal in a high number of properties. So if you're buying 200-300 properties a year, maybe you're like a real estate investment trust or some type of bigger acquisition company, you can leverage this strategy. But for most of us, this 3-to-1 strategy is going to make the most sense. Or if you have a larger property and you want to kind of 1031 exchange down in terms of property size, individual property size, but stay within that 200% total value, you can use this 200% strategy. Last but not least, we have debt. Typically, when we're rental property investors, we're using OPM, other people's money, which comes in the form of debt, right? And the debt on the property is good because it allows you to keep your tax profile low. Interest payments that we're paying on that debt, it offsets the rental income. So it reduces our overall tax profile. It's very good. But when we're doing a 1031 exchange, we have to keep debt in mind. We need to exchange into a property that's like kind of equal or greater value. You'll hear that all the time, equal or greater. That also factors into the debt. So if this property, the $100,000 property, has a $50,000 mortgage on it, I want this $200,000 multifamily property that I 1031 exchange into to also have at least a $50,000 mortgage. If I don't have an equal or greater amount of debt, then I could create some type of a taxable issue for myself here where, the IRS is sending me a tax bill at the end of the year that I was not anticipating and did not want to see. So there you have it. This is the nuts and bolts of the 1031 exchange. This is what you need to know at a high level, how you need to navigate this. This is a very powerful tax strategy. Once you master this, you can essentially avoid paying capital gains taxes forever. And once again, you want to hold these properties until death, then you can pass it down to your heirs tax-free. And this is how the wealthy stay wealthy with real estate. I appreciate you guys tapping in to learn a lot more about how you can put your family ahead, how you can build wealth through real estate with tax loopholes. If you haven't tapped into my free training, make sure you click the link in the description, tap into the free training, book a call with me one-on-one where we can talk about how you can uplift your family, take things to the next level. Brian Grimes, your real estate mentor, signing off.
Yeah. You're doing it, back to the flow, back to the flow. I take it back, yeah. Anybody born in the 80s, you know. Yeah. School, yeah. Out with the new, in with the old. High top bass, used to rock gold. Niggas used to chill before they started throwing bows. Used to run poison by Bell Biv DeVoe. Used to jump around with the House of Pain. Radio DJs bumming Candy Rain. Met the men and Mary J singing All I Need. Naughty by Nature had a banger called OPP. Jackson 5 killing it with ABC. Slick Rick rapping about armed robbery. Chris Cross at the time used to make